The Fibonacci extension tool is one of the most effective and widely used methods for projecting price targets beyond standard retracement zones. It's applied directly on the chart and helps traders anticipate where a trend might reach exhaustion, offering clear reference points like the 1.272, 1.618, and 2.0 extensions. But to really take advantage of Fibonacci extensions, it's not enough to just draw the levels and hope for the best. You need to understand how they are constructed, how each extension is derived from the previous move, and what these levels actually reveal about market psychology, momentum, and crowd behavior. In the next steps, we'll walk through how to apply the tool yourself, where to anchor it, how to interpret each level, and how to align it with the rhythm of real market trends. We'll look at how to project price targets beyond the retracement zone, where the 1.272, 1.618, and 2.0 extensions often serve as high probability profit zones, especially in trending markets. And as always, remember, Fibonacci levels are tools to guide your decisions, not guarantees. Use them with structure, but always combine them with risk management and context. Now, before we start drawing anything, there's one essential concept you need to understand: market structure. Fibonacci only makes sense when applied in the context of a trend. You need to recognize whether the market is making higher highs and higher lows, an uptrend, or lower highs and lower lows, a downtrend. Please, if you're still unsure about how to identify trends, highs and lows, or key pivot points, we highly recommend going back to the market structure video from earlier in the course. That lesson gives you the foundation you need to recognize swing points and trend shifts with confidence. And if you haven't yet watched our previous module on Fibonacci retracement, make sure to check that out first as well. It explains how pullbacks are measured and why levels like 38.2%, 50%, and 61.8% are so important. That knowledge is essential because everything we're about to do with Fibonacci extensions builds directly on top of that. Now, with that context in place, let's walk through the full process step by step so you understand exactly how and when to apply the Fibonacci extension tool. It all begins when you spot a potential trend shift on the chart. The very first thing you want to look for is a change of character, or chock. That's when the trend shifts direction, from bullish to bearish or vice versa, and signals that the market may be preparing to turn. Once the chock is confirmed, we bring in the Fibonacci retracement tool and place it using the current impulse move as a reference. At this stage, we don't draw the extension yet. We focus on measuring the pullback. Now, here's how we handle that. We keep adjusting the Fibonacci retracement as new candles form, always anchoring from the swing low to the current high. And we only start paying attention when price pulls back into at least the 38.2% retracement level. If it doesn't reach that level, we don't consider it a full pullback yet. It could just be noise or a weak pause in the trend. But once we do see a pullback reaching 38.2 or deeper, we watch for confirmation that the trend is resuming. And that confirmation comes in the form of a break of structure, or BOS. That means price breaks above the previous high after the pullback, signaling that buyers are in control again. Only after this break happens, we consider using the Fibonacci extension. That's when we go to the TradingView toolbar, select the trend-based Fib extension tool, and apply it using 3 clicks. The first click goes on the swing low, the start of the impulse. The second click goes on the swing high, the top of the move right before the pullback. And the third click is placed at the end of the pullback, the lowest point before price begins to move up again. Once you've done that, the extension levels will automatically be projected above the previous high. And from that moment on, you've got clear price targets on your chart. Levels like 1.272, 1.618, and 2.618 that you can now use to manage exits, take partial profits, or set trailing stops depending on your strategy. Now that you've learned how to apply the extension tool correctly, let's move on to the next step. Setting up the visual configuration so it's clean, readable, and aligned with the strategy we follow here at the ComLucro channel. Before we start customizing anything, I'm going to reset the Fibonacci extension tool to its default TradingView configuration. So you'll notice that it's going to look a little different on the screen for now. That's intentional. I want to show you exactly how to go from the default layout to the optimized version we recommend. Once the tool is reset, I'll draw it again on the chart using the same 3 steps. First click on the swing low, second click on the swing high, and the third click at the bottom of the pullback. That's how the tool anchors itself to the movement and starts projecting the extension levels forward. Once the Fibonacci extension is drawn, double-click on it anywhere on the lines or on the shaded area. That's going to open the settings panel where we'll now start customizing both the appearance and the functionality of the tool. The first setting you'll see is trend line. Leave this box checked. This is the diagonal line that connects the three anchor points, the low, the high, and the pullback. It gives a nice structural reference and helps you visually keep track of the move you're projecting from. Just below that, we have levels line. This is what controls the look of the horizontal Fibonacci extension levels. You'll want these to be bold and visible, so go ahead and click to change the thickness. Select the thickest line style available. This will make each extension level stand out clearly, even if you zoom out or have other drawings on your chart. Now, right below that, you'll see a drop-down menu labeled Extend. This is where you tell the tool whether or not the level should continue stretching across the chart. We recommend selecting the option Extend Lines Right. This means your Fibonacci extension levels won't stop short. They'll keep going into future price areas, giving you a better visual guide as the market continues to move forward. With the structure done, let's move on to the actual Fibonacci levels. By default, the tool includes a long list of levels, some of them useful, others not so much. The idea here is to clean up and keep only what really matters. In our setup, we use the following levels: 0, 1, 1.272, 1.618, 2, and 2.618. These are the most common extension targets in practical trading, and they're the ones we'll focus on. Now let's take a look at how we apply color to those levels. Not just for style, but to create a visual hierarchy. 0 is set to red. This marks the beginning of the move and serves as your anchor. 1 is also red because it defines the full length of the original impulse. It's a key structural point. 1.272 is yellow. This is often your first profit target, especially in conservative setups or shorter trades. 1.618 is orange, one of the most important extension levels, widely used as a main exit target. Then we have the 2.0 level in green, which represents a doubling of the original move and is ideal for strong trending markets. Finally, 2.618 is colored in purple. This is the aggressive target used when momentum is strong and price shows no sign of slowing down. Now scroll down to the Use One Color option. Leave this unchecked. That allows you to assign a different color to each Fibonacci level, which makes the chart much easier to read at a glance. When all levels have the same color, your eye can't quickly tell them apart. Keeping this option off is what lets our customized color scheme work. Right below that is the background option. Uncheck this as well. It removes the shaded area between levels, which only adds unnecessary clutter. With that turned off, your chart looks cleaner and your focus stays on the price action. Next, we have prices. You can choose whether to show the exact price at each level. In our case, we prefer to leave this unchecked since we're already labeling the levels by percentage, and showing both at once can create visual noise. Keep levels checked. This is what allows the values or percentages to show up next to each Fibonacci line. Under the drop-down menu, you can choose to display either the raw values or percentages. We recommend setting it to values for now, especially since the percentages are already visually distinguishable by their location and color. Now we go to labels. Change the first drop-down from left to right. This ensures the labels are always aligned to the right of the tool, no matter where price action moves. That way, even as price extends far beyond the current levels, your labels won't fall behind or disappear off screen. For the second drop-down, set it to middle. This centers the label directly beside each line, improving readability and keeping the layout tidy. Below that, you'll see text. Set the horizontal alignment to center and the vertical to middle. This combination keeps all text elements aligned in the most visually balanced way, preventing overlapping or misplacement near the levels. The font size option is next. It's set to 12 by default, but feel free to increase it to 16 or even 20 depending on your screen size or how zoomed out you usually work. Larger fonts make it easier to read the levels, especially when presenting or using a multi-monitor setup. At the bottom, you'll see the option Fib Levels based on log scale. This should stay unchecked unless you're working with logarithmic charts, which is rare in shorter time frames or most retail trading. And that's it. Your Fibonacci extension tool is now fully optimized with a clean, color-coded and readable layout. You've got only the essential levels, each clearly labeled, extended across the chart and styled for easy interpretation. Now that your tool is fully customized, we're ready to apply these levels in real market conditions and walk through how to use them to define precise exit strategies. Now let's switch to the Coordinates tab. This is where you can manually fine-tune the exact anchor points of your Fibonacci extension tool, both in terms of price and bar location on the chart. You'll see 3 fields here because this tool is based on 3 points. The first click marks the beginning of the move, the second marks the top or bottom of the impulse, and the third defines where the pullback ends. Each of these anchor points has 2 values, one for price and one for the horizontal bar position. The first point is the origin, the start of the move. The second point is where the initial impulse ends. And the third point is where the pullback finishes and the projection begins. These are the 3 coordinates that define the slope and distance of the extension levels. You normally set these points directly on the chart by clicking with your mouse, and that works perfectly fine for most cases. But if you want to be more precise, this tab lets you type in exact price levels and bar positions. That's especially useful if you're trying to match the exact high or low of a specific candle, or if you're replicating a setup across different assets with the same structure. Just remember, any changes you make here will instantly shift the extension levels on your chart. So use this tab when you want precision or when you're refining an already drawn setup. Now that you've seen how to control the coordinates behind the tool, let's move on to the Visibility tab, where we decide when the tool appears on your chart. Finally, we have the Visibility tab. This section allows you to control exactly which time frames your Fibonacci extension will appear on. You'll see a list of intervals organized by type: ticks, seconds, minutes, hours, days, weeks, and months. Each group defines a visibility range. For example, the 1 to 59 minutes range covers all intraday timeframes under 1 hour, while 1 to 24 hours includes all hourly charts. If a box is checked, the Fibonacci extension tool will be visible when you're viewing that time frame. If a box is unchecked, the tool will be hidden when that time frame is active. This gives you flexibility to keep your chart clean. Maybe you only want to see your extension levels on higher time frames like the 1 hour or daily, and not when you zoom into the 1 minute or 5 minute chart. At the bottom of the tab, there's an option called Ranges. This lets you create more advanced visibility conditions using custom time frames. It's a useful feature if you're working with specific multi-time frame strategies, but in most cases, you can leave this section as is. Once this tab is configured the way you want, that's it. Your Fibonacci extension tool is now fully customized. You've got the correct levels, clean visual layout, time-based visibility, and everything aligned with the structured approach we use here at ComLucro. Just a quick reminder before we continue. The previous video covered the Fibonacci retracement, which helps you measure pullbacks. If you haven't watched it yet, go back and check it out first. Now in this module, we're focusing on the Fibonacci extension, a tool that projects forward and helps you estimate where the trend might go after the pullback ends. These projection levels are especially helpful for setting exit targets and managing reward to risk during strong trends. Just like the retracement tool, the Fibonacci extension is built on the same key ratios, especially the golden ratio, 1.618, which reflects natural structure in price movement. In practical terms, the first level to watch is the 127.2% extension. It's often used as a conservative target, useful for partial exits or protecting gains after a pullback. Next is the 161.8%, the most important of all. This is the golden ratio, and in most strategies, it's the primary target when the trend is strong. Then comes the 200% level, marking a full duplication of the initial impulse. It's commonly used as a psychological target in well-defined trends. And finally, we have the 261.8% extension, a more aggressive target that tends to be reached in fast-moving, momentum-driven markets. Now this part is really important, and it needs to be absolutely clear. One of the most common mistakes traders make with Fibonacci extension is thinking it works like some kind of automatic profit target. They see price moving toward one of the extension levels and immediately assume it's time to exit the trade. No questions asked. But that's not strategy, that's guesswork. Fibonacci extension isn't a magic line. It's not a guaranteed destination. It's a projection tool, a way to map out where price might go if the trend continues. But for that to work, you need context. You need structure. You need confirmation. Because just like with the retracement, these levels don't hold value on their own. They hold value because so many traders are watching them, reacting to them, building their strategies around them. So yes, Fibonacci can be incredibly useful, but it doesn't work by itself. At ComLucro, we always say, never use Fibonacci in isolation. Always combine it with price action, trend direction, market momentum, and volume. That's how you build confidence in what the chart is actually telling you. Because at the end of the day, Fibonacci doesn't move the market. People do. Fibonacci extensions work best in trending markets, when price makes a clear move, pulls back, and then starts moving again. That's where these extension levels help you manage exits, partial profits, and reward the risk with structure and logic. But in sideways, volatile, or uncertain conditions, the tool can lose its edge. It might give you false expectations or pull your focus away from what price is actually doing. So the bottom line is this: Fibonacci extension is an excellent tool when used correctly. And that starts with understanding what it really is, what it's meant to do, and where it fits inside a complete, rule-based trading strategy. And that brings us to something we'll repeat in every video of this series. Because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory, it's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty, when they treat indicators as if they guarantee success. That mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, let me share a powerful idea from Mark Douglas, one of the most respected voices in trading psychology. He once explained that many traders believe their system or indicator told them what was about to happen. But in reality, the market moves because of the conviction, or lack of it, between buyers and sellers, not because of any mathematical formula. He pointed out that most of the reasons we hear in financial news are just stories made up to sound logical after the fact. And this illusion of certainty is what makes traders feel betrayed by their systems, thinking the methodology failed them, when in fact, no technical method can predict what will happen next on a trade-by-trade basis. As Mark said, technical systems only tell you what's likely to happen over a series of trades, never the next single one. And just to show how unpredictable the market really is, Mark once told a story about a trader he mentored. This trader was an excellent analyst, one of the best Mark had ever met, but he struggled to execute trades successfully. So Mark advised him to focus on analysis instead of trading other people's money. The man followed his advice and became an analyst for a major firm at the Chicago Board of Trade. One day, the firm's chairman, an old-school grain trader, sat down with him. The chairman was skeptical about technical analysis and wanted to see how it worked. As they watched the soybean market move within a range, the analyst confidently said that the current price would be the low of the day. The chairman laughed, picked up the phone, and ordered the sale of 10 million beans, 2,000 contracts, instantly driving the price down 10 cents. Then he turned to the analyst and said, "If I can do that, anyone can." And that's the lesson. Sometimes it takes just one player with enough size or conviction to completely destroy your perfect setup. So, the next time you find yourself waiting for that perfect signal, remember this: it only takes one player with enough power to make your setup irrelevant. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge. How you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast, practical decision-making. The Wyckoff method, to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.